أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله صلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome to our second day of chapter 10. We will jump right into it, inshallah. We started to talk about the management assertions, and management assertions are guarantees that the management of the client gives us about the financial statements. And we discussed the first two, occurrence and completeness, in the first category. So there are three categories: transactions and events. The second one is balances at the end of the period. And the third one is presentation and disclosures. So we'll continue our discussion. The first two that we discussed briefly, the first one is occurrence, that is anything that is recorded in the financial statements, anything that you find in the financial statements, you will find evidence that it actually happened. So the management says that we have not recorded anything except it happens. You find a journal entry in the financial statements, you will be able to find proof that that journal entry was recorded because an event that took place. So if you have a sale recorded in the financial statement, you will find a sales order, shipping document, sales invoice, all the necessary documents that support that entry. So that's the first management assertion. The second one is completeness. That is, anything that happened, it was recorded and it was not missed. So if there was a sale, it was recorded. If there was a purchase, it was recorded. So if you take a sales invoice or a shipping document from the client's office, you will find that there is a journal entry in the financial statements because of that. Okay, so when you test the completeness, you start with the documents and you go forward to the journal entry. When you test occurrence, you start with the journal entry and you go backwards to the source document. Okay, so these are the first two. The third one is authorization. That is, the client says that anything that needed authorization was properly authorized. That means that if the client had a customer whose credit had to be authorized, you will find evidence that it went through proper authorization. Okay, if there is a purchase that needed to be authorized from upper management, you will find that it was properly authorized. So this is the management assertion of authorization. Are you following so far? Are you with me? The fourth one is accuracy. The management says that everything that was recorded accurately. So if you have a sale that took place that was for $1,000, you will find that it was recorded for $1,000 and not more or less, right? So everything is recorded accurately and you can check the accuracy as well. Okay. The fifth is cutoff. Cutoff is the easiest management assertion to test, but it may be a little bit to understand what it is. So cutoff means that every transaction is recorded in the proper period, and this is for the period for which the financial statement is prepared. So let's say you have a 2020 income statement and a 2020 balance sheet and a 2020 statement of cash flows. Anything that is recorded there happened between January 1st and December 31st. So nothing from January of 2021 is recorded in December of 2020, nor anything from December of 2020 is recorded in January of 2021. Because you just understand, if there is 1 or 2 or 3 days of delay in recording at the end of the period, right, last part of December, it could easily go into January. And if something is recorded by chance early, then it could come inside December, but the actual event actually took place in January. So cutoff is the cutoff between the two periods. December's items are recorded in December, January's items are recorded in January. That's what the client is saying, and you can test that. Okay, does that make sense? Okay, that's cutoff. Now, the next one is classification. Classification is every single item is recorded in the right account. It is recorded in the right account. It is classified properly. So you're not going to find rent expense recorded as inventory. You're not going to find office supplies expense recorded as advertising expense. You're not going to find a long-term asset recorded in the current assets. So everything is classified in the right place. Every transaction is classified in the right account, and you can check that. All right. So far, so good. These are the first 6 in the first category, which is transactions and events. Okay. Now, these will continue to become more and more clear to you as you check these individual management assertions in different business processes. And we are in the revenue process, which is the same as the revenue cycle in accounting information system. Those who took it with me, you studied accounting information system, revenue cycle, same thing. Revenue cycle, revenue process is the same thing. We are in that chapter, so we're going to check these management assertions for things that took place in the revenue process, and we are going to understand each one of these management assertions more and more as we go forward. But it's very important for you to understand what management assertions are as we start our discussion, what we are trying to test. There may be a situation, it happens sometimes, 2, 3 chapters down, a student will ask, Doctor, what is management assertion again? And that is, the student has been with me throughout this time when we discussed 2, 3 chapters, but the student has gone through this without understanding what management assertion is. When I say that, please understand, I do not in any way discourage you to ask a question at any point in time. So all questions are good, and they're good anytime. So you can ask me anytime during the class, any question about anything that we have discussed. There is no bad or stupid questions. You should feel free. You should also feel free to send me an email with a question anytime during the day, any day of the week. As soon as I see it, inshallah, I will respond. Okay, the purpose here, the purpose of you being at the university is for you to learn, right? And I am here to facilitate that. So if I do not facilitate that, why am I here? All right, so you should not feel hesitant to ask a question or ask for help. Anything you need, you should ask me, inshallah. Okay, so don't feel like that. The reason why I'm not discouraging you to ask questions, I'm encouraging you to understand from the beginning. So if you somehow fall behind, no problem, it happens to all of us. Ask me, inshallah. Okay, is that clear? Are you following? Right? So just like any of my children, I want every single one of you to be successful, inshallah, and I'm here to help you. Okay, let's jump into the second category, which is balances at the end of the period. All right. Balances, when we say balances at the end of the period, we're talking about the balances in the balance sheet. The balance sheet has 3 different types of balances. You have assets, you have liabilities, and you have equity. Okay, 3 different types of balances. The management gives you certain guarantees about these balances. Management of whom? Whose management are we talking about? Let's see if you're awake. Let's see if you had coffee. Let's see if you're alert. If you're alert, management of whom? Quick, quick, tell me. Client. Very good. Who's the client? Quick, quick. We have a lot of stuff to talk about. Who's the client? Not the name of the company. The company under audit. Outstanding. Very good. Excellent. The company under audit is the client. Excellent. Who are we? Who are we? Those people who are not still awake. Only Hamza and Muhammad Al-Sada and Sharat is participating. How about Ahmad Al-Shaimi and Jasim and Motasif and Muhammad Nasr and Jasim? Jasim, who are we? Auditing company. Independent external auditor. Independent external auditor. Hamza, very good. Jasim, you still didn't take your coffee yet. Okay, no problem. Independent external auditors. We are independent external auditors. Remember that, okay? Did you hear that from me before? Independent external auditors? You're just making it up, Hamza. You heard that from me before? You heard it from me before? Yeah? No problem. All right. So let's see what the management of the client is guaranteeing. The first thing that they guarantee is existence. What does existence mean? What does existence mean? If they reported a building in the balance sheet, if they say that we have a building, if you go to that location where they say they have a building, you will find the building. It exists. It is real. It is not something bogus. If they say we have 100 boxes of inventory at this warehouse, if you go to that warehouse, you will find it there. You will find that they actually have that there. It exists. It's real, right? You will find it. That's called existence. Is that clear? Is that clear? The next is rights and obligations. Remember, rights and obligations, these are two words. The rights apply to assets and the obligations apply to liabilities. So rights meaning when they say asset and they have a building reported in that asset, they actually have the right of ownership. They own that. So if you say that you have this building, it exists, I can see the building, but can you show me that you own this building? You have the right of ownership, right? You have haq on this. This is yours. They can show you paperwork that shows that this building belongs to us, or this truck belongs to us, or this land belongs to us. They can show it to you. Okay, that's rights. Obligations, on the other hand, are about liabilities. So if they have a loan, they can show you the paperwork that proves that this is their loan. Okay, that's an obligation. If they have an accounts payable, they can show you paperwork that says this is their accounts payable. So that's obligations, right? Rights relate to assets, obligations relates to liabilities. Clear? Clear? Okay. The third one is completeness. Completeness. Every single asset and liability and equity, every single item is completely recorded. So if they have 5 loans, they did not record only 4. They recorded all of them. If they have 5 buildings, they recorded all 5 of them. If they have 200 tons of inventory, they recorded all of them. Everything is completely recorded. Nothing is left out. Clear? That's what the management says. You can test it. How do you test it? We'll come to that. Okay? The fourth one is valuation and allocation. Valuation and allocation. There are certain assets and liabilities whose values are sometimes calculated, sometimes estimated. And the client says that everything that we have recorded is recorded for the proper value. So let's say they have a vehicle recorded. Let's say they have a Mercedes on their balance sheet, a company car, a Mercedes, and it's recorded on the balance sheet as $300,000, value of 300,000 reals, let's say 300,000 reals, right? And you go and you find that that Mercedes is a 2000 model, a 21-year-old Mercedes. Is a 20-year-old or 21-year-old Mercedes worth 300,000 reals? Normally, is that the right value for that Mercedes? What do you think? 21-year-old vehicle. What do you think? Is that the value? Is that the right value? It's not, right? So they say that everything that is recorded, that thing is probably fully depreciated, right? It's probably 5,000 reals, worth 5,000 reals, if that, if it will sell for 5,000, you have your doubts. So the value, and there are certain things that are valued, for example, certain types of inventory, certain type of assets, the value is calculated based on certain estimation and certain expert calculations. And the client says that everything that we have recorded is for the right value. So the valuation. So that's the management assertion of valuation. You can test it. Okay. And allocation means allocation or distribution among the different accounts is accurately done. So let's say you have 3 different types of inventory. You have raw material inventory, you have work in process inventory, you have finished goods inventory. The inventory items are allocated to the different accounts properly. So if they say raw material, it's not actually finished goods. If they say finished goods, it's not actually work in process. Each one of these items are allocated into these accounts properly. Okay, so the value is accurate and the allocation is accurate. Clear? Okay, very good. So you can check all of these things. How? We will come to it, inshallah. So this is the second set. The third set is presentation and disclosures. Presentation and disclosures are not only about the income statement and balance sheet, but they are also about footnote disclosures. What do we mean by footnote disclosures? In every financial statement package, in the annual report, you have an income statement, you have a balance sheet, and you have a statement of cash flows. But along with that, you have pages and pages of footnote disclosures, additional information that you cannot report in the financial statement format. For example, they may discuss the launch of a new product. They may discuss the closing of a particular branch. They may discuss a new method of doing business. They may discuss the possibility of borrowing more money. They may discuss the terms and conditions of the existing loans, etc., etc. Those are not possible, for them to report. It's not possible for those items to be reported in the income statement or the balance sheet. So they are footnote disclosures. In the footnote disclosures, pages and pages, 50, 60, 100 pages sometimes, and you have to read as an auditor to see if they meet certain criteria, if they meet certain conditions. What does the management say about the footnote disclosures? Presentation of the financial statements as well as the disclosures. They say, first, these three are coupled together, occurrence and rights and obligations. Same thing if they have reported something. So let's say they say that we are going to launch a new product in 2 months. You can see whether this is actually happening or not, whether this is true or not. You can see, you can check, you can visit the client, and you can see that this actually product is almost ready, right? So it actually happened. And you can also check rights and obligations related to assets and liabilities. If they reported certain assets that they're going to either acquire in the future, or they have some details about certain assets, you can check and see whether it's theirs. Same with the loans and liabilities, you can check it's there. So it's disclosed in the footnote disclosures. So this is in addition to the financial statements. The second management assertion related to this is completeness. Same concept, everything is reported, nothing is left out. So let's say they have 3 court cases going on and they might lose 2 of them. They discussed all 3 court cases in the footnote disclosures and not just 2 of them. And whether they have to be disclosed in the footnote disclosures or they have to be reported as a contingent liability in the balance sheet, it depends on the situation. You have, if you have taken intermediate accounting 1 and 2, you have come across something called contingent liability. Do you remember something like that, where the possibility is remote, the possibility is probable? Do you remember something like that? Right? So again, you don't have to remember that to understand what we are doing here, but I'm giving you that example because in this course everything comes together, right? This course, everything comes together, and you don't have to necessarily be an expert in those courses. Anything you need to know, I'm going to refresh your memory about it, and we will practice, inshallah. So you should not feel stressed if you do not remember that. But my point of mentioning this here is all of those things are completely reported, and you as the auditor will check whether that is reported properly or not. Next one is classification and understandability. When we say classification, we are saying that it is classified in the right place. So let's say if it is a contingent liability, certain contingent liabilities, you have to record a liability, a payable in the balance sheet. In certain cases, you have to just write about it in the footnote disclosure. So whatever the situation is, this item is classified in the right place. And again, my dear students, my sons, there is so much to learn about this. I am just giving you an introduction. I'm just giving you the tip of the iceberg, just a little bit in this course. But this little bit, if you can organize this in your head, then you can add information as you start working, inshallah, very soon, in a few months, or less than a year, inshallah. When you're working, you can add, if you can build a structure in your head about these things, you can continue to add information, and it will make you a very good accountant, a very good auditor, inshallah. So this classification is putting the right item in the right place, right? So as an auditor, you need to keep an eye that this is reported in the right place. The next thing is understandability. The writing in the footnote disclosure should be such that a non-accountant should be able to read and understand. Because remember, most of the people who are going to read the financial statements and the footnote disclosures are not accountants. They are investors, right? So if you as an accountant, an expert individual, have difficulty in understanding what they have written, for sure the person who's not an accountant will not understand. So this must be clearly stated. So you should tell the client if it is not understandable, then it should be written in a more plain language. Okay? And lawyers write these things, and I once saw a description of one page where something is described, and it's an orange, right? The lawyer described an orange, and it took him one page to describe the orange. You follow what I'm saying? And at the end, I couldn't understand exactly what the lawyer was talking about. So this type of description is not something that they should have. It should be understandable to a lay person. Is that clear? The last is accuracy and valuation. Same concept as we discussed before, accurate and for the right value. This relates to the disclosures, right? The presentation and disclosures, they should be accurately disclosed and for the right value. And I know I have given you a lot of information in these three slides, and these things will continue to become more and more clear as we go through the applications of these management assertions. Okay, as we go through the applications of these management assertions. I know it's premature to ask, but do you have any questions at this point before we go to the next slide? Are you somewhat following? Okay, very good. And it will become more clear, right? It will become more clear to you, inshallah, as we discuss. So we will discuss one more thing, and then we'll do the quiz. We have a quiz at 9:40, inshallah. I'll give you the password at that time. Let's bring your focus for 10 more minutes with me. Very, very important. Everything will build on this. Before we start working on the audit, we calculate something called an audit risk. This is based on, the audit risk is based on the auditor's judgment. The auditor's judgment. Auditor's judgment is based on auditor's experience, auditor's knowledge, auditor's understanding of the circumstances, auditor's exposure to the client in the past. So all of these things combined, the auditor has set an audit risk. What is audit risk? Audit risk is the risk that you give an opinion and the opinion is not right. So you say unqualified, but it's not. You say qualified, and it's not. Okay, that's the audit risk. Don't confuse this with the sampling risk. What is sampling risk? The sampling risk is the risk that you have taken a sample and the sample is? Come on, guys. Sampling risk. You'll fail the quiz. Fail the quiz. What is REP? Tell me properly. Non-representative. Jasim, excellent. The sample is non-representative. It is not representing the what? The sampling is not representing what? The sample does not represent what? Quick. Population. Ahsant. Jasim, excellent. Very good. All right. Very good. Hamza, I know you know, but you should write properly, okay? I told you, start writing as a professional, right? Consider yourself, think of yourself as an expert auditor dealing with professionals. So write fully, write properly. Okay. Audit risk is the risk of giving the wrong opinion. We decide this. This could be quantitative, this could be qualitative. Here we have the number 8, but you could assign high, low, moderate, etc. That's the audit risk. The second in this formula is inherent risk. Inherent risk. Inherent risk is the risk because of the circumstances, meaning the client is in a particular industry, the client is in a particular location, the client is in a particular situation for which there are certain risks. The client cannot do anything about it. The auditor also cannot do anything about it, but the auditor can learn about it. For example, let's say the client is in the oil industry, right? The client is in the oil industry and the price of oil fluctuates. The price of oil goes up and down. Because of that, that particular client is in a particular type of risk of reporting the price. Jasim is saying corona pandemic, absolutely, that is also, but the pandemic is more general. This applies to almost all businesses. Inherent risk is more specific. Now, your client could be more vulnerable due to corona, but that's not just due to corona, that's due to the industry they're in. For example, if your client is in the industry of selling necessary goods, vegetables and fruits and food items and medicine, they have a less of a risk than if they're in a particular specialized industry, for example, tour and travels, right? Or airline industry. So they don't just have an inherent risk because of corona, but because of the industry they're in as well. Okay, do you follow? Does that make sense, Justin? Right? So the industry or the specific situation of the client, so it's a client by client. Now, when I was working as an accountant, we were in the restaurant industry, and every month we would subscribe to quite a few, 7, 8 magazines and journals that the restaurant owners read. So those would come to my office and I would go through them, I would read them, and I would try to see what is happening in the restaurant industry, what is the price fluctuation for cheese. For example, Domino's Pizza was our client. They're still the client in the firm that I was in. And in my MBA class, my former boss made a presentation last semester showing the students the difference between the performance during 2020 and comparing that with the performance of 2019, real companies' price fluctuation and business fluctuation and sales fluctuation and so forth. So, because of that industry, because of being in that industry, we used to read their magazines, and they still do read them, right? The Domino's Pizza is still their client. Hundreds of stores they have, and we used to read them, and we used to try to understand what is going on in the industry, right? So the inherent risk is something that you understand through your experience, through your reading, through your interaction with the client and the business journals and so forth. and then you set the inherent risk. So the auditor decides what the inherent risk is based on all of these actions. Is that clear? The inherent risk part. Are you following? Are you with me? How I wish I could look at your faces and see whether you understand and whether you're following. Because when I ask a question, I have very few people responding. 8 people in class, and 2, 3 people are responding, and the others are not saying anything. So are you following, or are you there on the other end, or you have left? Okay. The second one is control risk. The control risk is based on how good or bad the internal controls are of our client. The internal controls are procedures put in place to ensure how many things, quickly, how many things. Internal controls are in place to ensure 3. Very good. What is the first one? Quickly. What is the first one? Preparation of true and fair financial statements. Very good. What is the second one? Quick. And what is the third one? What is the second one and third one? Quick, quick, quick. The second one is effective and efficient operations. And the third one is compliance with regulations, right? Effective and efficient operations and compliance with regulation. How do we determine the control risk? The better the controls are, the lower the risk is. So if the client has very good controls, that means the financial statement prepared under those controls are also going to be good. Good controls generally produce good financial statements. So good controls will have less control risk for you. So you have less control risk because the client has good controls. That's the second. The third one is the detection risk, which is calculated using this formula. So this number is plugged. You calculate this number, okay? You calculate this number. How much is this number in our example? What would the detection risk be? What is the amount of detection risk? Quick, quick, quick. 2. Okay. Now, the detection risk is calculated first, and based on the detection risk, the auditors decide how much to audit. How much do you need to audit is decided based on what the detection risk is. When I say audit, let me see if we have a genius in the class. What do I mean when I say how much to audit? How much to do what? What are we talking about when we say how much to audit? Let me see. Let me see if we have a genius in the class. How big the sample should be, that is correct. But when I say how much to audit, what do I mean? When I say audit, what I mean? To do what? If you're test of details, outstanding, exactly, test of details, or substantive procedures. Now, I'm going to tell you something which is a little bit difficult to swallow, but understand, remember this, and then you will understand it as we move forward. The bigger the detection risk is, the less you have to do substantive procedure. It's difficult to swallow, but remember this. The higher the detection risk is, the lower the amount of test of details or substantive procedure you would have to perform. So what is the relationship between detection risk and substantive procedure? Larger the detection risk is, the lower the substantive procedure is going to be. Is that clear? Remember, the detection risk is calculated first, then the substantive procedure is performed. On the other hand, you check the inherent risk issues, then decide what the inherent risk is going to be. You test the controls, then decide what the control risk is going to be. Okay, so these two things are done first, and then you come up with these numbers. In the case of detection risk, you have to calculate this number first. Then you do the substantive procedure, because this will decide how little or how much substantive procedure you have to perform. Is this clear? Okay, so remember this. What is detection risk? Detection risk is the possibility or the risk that there is an error and you did not find it. Okay, there is an error and you failed to detect it. That is the detection risk. You failed to detect the error. That is the detection risk. Okay, so we'll stop here inshallah, and we'll continue from here. You can go to the content section of Blackboard and take the quiz. The password is 2025. I'll stay around for just a few minutes inshallah if you have any difficulties. I'll see you in class on Tuesday. Assalamu alaikum warahmatullahi wabarakatuh.